Hello. Welcome to this week's Private Funds Update. I'm Sandra from SmartEsq. Here's what I learned this week. We start with the mechanics of retailization. On March 5th, the SEC's Division of Investment Management released comprehensive new FAQs on Rule 12D1-4, the framework governing fund-of-funds arrangements. For private equity and credit managers expanding into the retail channel via business development companies or interval funds, this registered fund plumbing is now your problem. The new guidance dives deep into the technical conditions required when one fund invests heavily in another. Specifically, the SEC clarified the mirror voting requirements, dictating exactly how an acquiring fund must vote its shares to prevent undue influence over the acquired fund. The FAQs also provide strict parameters on how to calculate control thresholds and detail the specific findings fund boards must make to ensure retail investors aren't being hit with duplicative, layered advisory fees. Staying on the topic of retail capital, the SEC hosted a high-profile roundtable this week, focused on the broader implications of retail access to private markets. While valuation smoothing and liquidity mismatches were major themes, the conversation went much deeper. First, the accredited investor definition. There was significant debate over whether the current wealth and income thresholds are outdated and whether the SEC should pivot to a sophistication or knowledge-based test. Second, disclosure. Regulators are openly questioning whether the dense, complex disclosures typical of private funds are actually digestible for retail investors, particularly regarding hidden fees and illiquidity risks. Finally, the SEC put the gatekeepers on notice. For broker-dealers and RIAs recommending these products, the agency emphasized strict compliance with regulation best interest and fiduciary duties. This roundtable may be a precursor of the SEC's further guidance or regulation relating to the retailization of the alternative investment sector. Turning to cross-border M&A, on March 4th, the European Commission formally presented the Industrial Accelerator Act to the EU Parliament and Council. At its core, the Act establishes a stringent, mandatory pre-closing review process for investments in critical sectors. Think advanced tech, defense, and green infrastructure. It introduces a strict strategic autonomy test, giving regulators broad powers to block or condition deals if they believe a foreign buyout threatens Europe's supply chains. It also bakes in Invest European incentives that explicitly favor domestic capital. If passed, this act will impact managers on both sides of the Atlantic differently. For U.S. sponsors, this is a new foreign direct investment barrier, meaning longer deal timelines and a heavy burden of proof to get deals cleared. For EU-domiciled managers, it offers a distinct home court advantage in competitive auctions. However, EU managers relying heavily on US or Middle Eastern LPs must be careful. Regulators are expected to look through the fund structure to ensure foreign capital isn't bypassing the rules. Staying in Europe, the European Commission has just launched a targeted consultation specifically focused on private equity exits. With the European IPO market remaining sluggish, regulators are taking a hard look at how sponsors are returning capital. The Commission is scrutinizing the industry's heavy reliance on alternative liquidity routes, namely sponsor-to-sponsor secondary buyouts and continuation vehicles. The stated goal is to figure out how to revive public listings and make European capital markets more attractive. But for GPs, this consultation indicates that regulators are closely watching the pass-the-parcel dynamic of private markets and may use more microscopic scrutiny on CVs and sponsor-to-sponsor exits in the near future. That's it for this week. You can learn more about these topics from me on the SmartEsq platform. If you are curious about the services we offer, please visit www.smartesq.ai.